That's the first percent of fair value gap at 9:35. First, you have to remember, how did we open up the day? Premium gap. So when we have a premium gap, I want to see price try to get down towards that gap. That's the first order of business all the time. When we have a premium gap, I want to see price trade down. What's a premium gap? Opening higher than where we settled previous day in regular trading hours. So this is a premium gap. Find consequent encroachment. That's that level right there. So for the first 30 minutes of trading, that's the opening range. First protocol is anticipate that happening. Whether or not it happens, that's the first thing in ICT's mind. I'm looking for that. Now, how do I incorporate that with the first presented fair value gap? Think about it, okay? We gap higher here. So first protocol is find mid gap, consequent encroachment there. In my mind, I'm looking for something to formulate in a structure or framework to lead to that drawdown into that particular price level, not a zone, that particular price level right there. That's what I'm looking for. Best case scenario, full gap closure. You have to have a low hanging fruit objective. Okay. So, low hanging fruit objective would be obviously the opening price or the lowest of that first minute candle. So, when it opens up and it's running up here like that, I'm anticipating very minimum trying to get back to the gap, consequent encroachment by 10 o'clock. I'm not hardlining it. I'm not saying it has to be by 10 o'clock. I'm just saying there's a 70% chance that it's going to do that. I'm going to see that 70% of the time, the first 30 minutes, half gap gets traded to. Now, that's a huge advantage for bias for session, not daily bias. It's the what to do right now. Okay. So at 9:30, it opens here, starts ripping higher. We already have a built-in advantage that it's likely to go down into the opening range gap. Minimum low-hanging fruit objective would be 9:30 opening price or whatever the low of that candlestick is, because that's where engineered liquidity is. There's no trading there on regular trading hours yet. Electronic trading hours, it's been there, but regular trading hours has to book it. That's the efficiency model that regular trading hours implements. Regular trading hours has to book that price. So sell side below this low, that's the low hanging fruit objective. Midpoint of the opening range gap is consequent encroachment. 70% chance by 10 o'clock it can trade there. That is not 100%. It just means you have a high degree of probability it's going to trade there. Now, what do you think that means when price is trading higher? Let's go back into a electronic trading hours. When it's trading higher like this, right from Jump Street at 9:30 here, when it's rallying up here and it's taking out buy side. It takes out the minor buy side here. I said that we would take out this buy side, which is over here, here at these relative equal highs, and this one here. So it ran through both of them and then gave up the ghost, went lower, took out the low of that first minute candle, and then didn't get to consequent encroachment of the opening range gap, but it did take out that low. Then rallied up and cleared a higher time frame pool of liquidity. I used this idea here that it could trade up there and use that as an inversion fair value gap. Hits it, trades down to a little bit there, and then they pump it one more time. That's Phil. Who is Phil? Phil is the guy that can push a button, slide a little dial here, turn a little knob there, and cause a little bit of chaos. So that's my way of telling you this is tomfoolery, this is manipulation, this is manual intervention. When it created that and traded down in here, I mentioned later in the day that I felt that sell side was, basically being, it was an obvious, it was going to trade down there and get it. So where was sell side? Sell side's below here, sell side's below here. It went back to first percent of fair value gap. And while we were in this little area here, I said that, the 1 minute time distortion right here gets cleared up if you go to a 5 minute. So we're going to go to a 5 minute chart. See this right here? Let me go back to the 1-minute charts. 9:30 candlestick this morning. That's what I'm looking for. And then now, first presented fair value gap, 9:35. So when we go back into the 5-minute chart, you'll see what I'm referring to. There we go. So there's the first presented fair value gap there. But now watch what happens. We have this buy side imbalance, sell side inefficiency right here. So this gap is just this wick to wick. Now extend that forward. What price was simply doing is utilizing the inversion fair value gap, rather. Drop down to the 1-minute chart. All right, so we have the 5-minute inversion fair value gap. Look where the bodies are. Are the bodies touching the high of that inversion fair value gap that's anchored to the 5-minute time frame? No, it's not. So yes, the wicks can color outside the lines. It can do that type of thing. And when you're watching price action, this can make you nervous. This is the part that you're supposed to be doing when you tape read. You get acclimated to it. You get comfortable with it doing it. The body's not touching the high of that inversion fair value gap is the signature. That's the algorithmic signature. That's the big neon sign, the billboard sign saying, hey, look at me. I'm not posting a body to the high of this. Something's happening here. Some random level like this is causing the bodies to stop and not touch the high of that box that I showed you on the 5-minute chart. This clears up time distortion because you see what they're utilizing. When that 1-minute chart sloppiness in here was happening, all it was doing was showing you that the bodies aren't even touching consequent encroachment. It wasn't doing it. So what is it going to do? It's going to go for what they left, sell side. So this 5-minute inversion fair value gap clears up 1-minute time distortion. The rule is if you're seeing shared ranges in the candlesticks on the time frame you're looking at, go up a time frame. And you'll see it's just simply utilizing a higher time frame inefficiency or PD array. And that's what you're seeing here. So this sideways consolidation gets cleared up by going to a 5-minute chart. And that range, that inversion fair value gap is here. So just simply knowing what that range is not enough. What did they accomplish and complete this morning? They ripped it higher with a premium gap opening from 9:30 opening bell. And then here is the previous settlement price. That's this level down here. Regular trading hours, settlement previous day. This is a higher gap opening on Monday. So the last trading day, settlement price, 414, then reopening on regular trading hours. That's a higher gap opening because it's higher than the previous settlement. And then you split that range in half to get consequent encouragement. That's your target for the first 30 minutes of trading. 9:30 to 10 o'clock. That's what you're looking for. You're looking for price to gravitate back to this. That's everyday operation protocol. That's a SOP, standard operating procedure. That's a 100%. I'm looking for that every single day until proven it's not going to do it. You're looking for something to set a run towards that direction. Whether it hits that level or not is irrelevant, absolutely irrelevant. It's just that's your first initial draw. That's what you should be doing, okay? So again, with that said, here we have it. Bodies can't even touch consequent encroachment of that. Then we get this drop down right afterwards. So the consideration is that we're sharing a lot of ranges here, and that's time distortion. So time distortion is cleared up by going up to the 5-minute chart. You get this imbalance. The bodies can't even touch consequent encroachment. That's real bearish order flow. And I said, what did it accomplish this morning? And who's profitable? The longs from opening, and then come down and stop them out. Then all this run up here. The breakout artists, okay, that bought the break above, old buy side liquidity. As I saw that, I said, I like this. It's going to pull back into the range now. It did. So longs have been bullish from here, and their net longs positions have stops below that low. What's below that low? Consequent encroachment of the opening range gap on regular trading hours. So in here, time distortion gets cleared up by going to 5-minute. 5-minute inversion fair value gap. Bodies are saying absolutely not, ICT. Look what they did. They ripped it higher, made it jagged on the upside. Where is sell side? Here. The opening range gap for regular trading hours is going to be a factor for later in the day. It's going to be drawn too. Failure to go to midpoint here is indication that order flow is now bearish. Absolutely. Look for lower prices. Lower, lower, lower. This gap I gave you during the live stream, it uses it here. Trades down below the low here. Doesn't get below this low, but trades to the rejection block. Lowest down close. It does that there. Then pulls back up into that 5-minute inversion fair value gap. Trades down again, consolidates a little bit. It's during what time of day? Lunch. Lunch goes to what? 1:30 p.m. Eastern time. 1:30 Eastern time is here. So it can create the lunch macro all through that time between 11:30 to 1:30. That's your 2-hour window. We get back up in the deeper end of that 5-minute inversion fair value gap. We're trading up into it here, here, here. But look at the bodies. What is it telling you? When you look at where price is showing you, where the bodies are saying, no, we won't even touch the high end of it. Even though the wicks do it, the bodies are saying, absolutely not. We're not doing it. And then at a random time where no one would reasonably expect price to do something, at 10 minutes before 1 p.m. Eastern time, everything comes together and price starts running lower. The market was made jagged on the upside. The sell side was the target. The opening range gap, regular trading hours, opening range gap. That's these levels here. That's the high of it. That's the low of it. That's the draw. Okay. This same gap I gave you this morning over here, it's used here to pump up into that. We trade through it here. Look what it does with it right there. Look at that. Trades through. One more time. Done. Trades lower. So the run starts here at 12:50, 110 macro time. It starts dropping off. We rally up into the high end of that inefficiency this morning. This one here, as it was running up here, it only trades up into this gap. And it can't even touch that inefficiency there. That's bearish too. So you would see this gap and then anticipate willingness to try to touch this low and maybe wick to the midpoint. That would have been permissible during that time, but couldn't even do that. What does that mean? It's weak. So if it's weak, it's heavy. If it's heavy, it's going lower. Where's it going to go if it's going to go lower? Here's the high of the opening range gap for regular trading hours. Upper octant, upper quadrant, octant, consequent encroachment, smashes through that all the way down to full gap closure, and just for good measure, overshoots it a little bit. Now watch. Once it does that, we start trading higher. This right here, this inefficiency, price runs back up, back into some random level in the first presented fair value gap. Look where the bodies are stopping. Trades lower, uses that same gap again here. Bodies don't touch it on the closing basis. Only the wick does it. We trade lower and then trades down into what? Inefficiency. This is your what? Inversion. Sell side imbalance, buy side efficiency. We trade above it. It's going to come back down into it. Uses that same fair value gap again. And then we move into this. All of this sideways consolidation and runs right up into that gap. Look at that. Look at the bodies. It can't even touch consequent encroachment or that gap. This gap, remember, it's this. And the logic is it was running liquidity. And it need not take this high out of that wick because the wick's inefficiency. So the point is, the logic I teach for institutional order flow is that if it's bearish, if it can't lay a body on that midpoint or consequent encroachment, that is indicating what? It's not strong. If it's not strong, it's weak. If it's weak, it's heavy. If it's heavy, it's going down. Gravity takes over, pulls it down. Low, higher low. Sell side below there. Inefficiency there. Also, see that volume imbalance? Volume imbalance to that high. That's your inversion fair value gap. As soon as it traded up into that right there, fine. But the stop loss would have to be above that high. Why? How could you trust that? Because it already gave you the indication that it's already heavy here because it can't even put the body up against the consequent encouragement level. It wicked from open up and then closed immediately outside of it. The next candlestick opening here, you can go in that candle right away and just start selling short, 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 short. The next candle, when it opened up here, wait for any candle that makes a run back up inside this here. That candle right there, you may or may not be able to pull that off because it could have happened pretty quick. And then look how fast it dove out of there. Beautiful, beautiful price run. Like that's low resistance liquidity run conditions. When it does those types of runs, that's what I'm training you to find. And when they form, they are always 100%. Listen to me. They are 100% always originating off of what I teach as a PD array. It's never some random thing. Okay. Look at this right here. Buy side. Okay. Buy side. Right before that buy side's taken, what did I teach you to look for? That gap that's formed before the buy side's taken. This is also reversed when sell side's taken. Buy side taken, the inefficiency right before it happens. There to the volume balance high. What do you see? Are the bodies able to lay inside the upper half of that? Nope. So is that order flow bearish or bullish? Bearish. And then what does it do? It dives lower. Does that look as clean and as perfect as what I'm showing you here? It's using that inefficiency and then the logic of stay out of the upper half of the bodies. But there's no algorithm.